So this article that I read was a Wall Street Journal article on revenue recognition in partnership with Deloitte. It breaks down the new revenue recognition model and its impact on technology companies. The article explains how Financial Accounting Standards Board introduced a standardized approach for recognizing revenue, which replaced older industry-specific methods. This new framework ensured consistency across businesses, particularly in industries like tech, where revenue streams can be complex. I learned that revenue recognition follows a 5-step model. First, you identify contracts, then you pinpoint performance obligations, you determine the transaction price, you allocate that price, and then you recognize the revenue when all of those obligations are fulfilled. We talked about that in class, about how it's so important that all of the obligations are fulfilled in order for revenue to be recognized, and that's how we're able to properly account for it. This is important for tech companies because they bundle their products and services, kind of like the Better Buy case series that we had, or case study that we had. One of the biggest takeaways is that revenue isn't always recognized up front. It often has to be spread out over time. For example, if a company sells a year-long software subscription, they can't recognize the full revenue immediately. Instead, they have to account for it over the contract period. This is relevant because it directly impacts financial statements, investor confidence, and business decision-making. Companies need to carefully assess how they structure those contracts, how they estimate variable pricing like discounts, and how they're able to stay compliant with the stricter reporting requirements. The article ends up highlighting that while this model increases transparency, it also presents challenges, especially for companies that frequently modify contracts or offer multiple services in one package. Businesses now have to provide more detailed disclosures about how and when they recognize revenue, which means accounting teams need to be more precise than ever. Overall, this article reinforced how critical revenue recognition is, not just for accountants, but for business leaders, investors, and anyone involved in financial planning. Understanding these rules helps to ensure accurate reporting, strategic decision-making, and long-term financial stability.